All right, we have the first question here. Can someone read this long paragraph for me? Because by the time I'm reading it, then I start explaining, I'll be tired. Okay, I'm not a papa who speaks for 100 hours. So could someone read for me? Then after you read, then I'll start the explanations. Could someone read? Madam Tandiwe, I heard you got 100% in this. If you could read for us. Or Madam Juliet, another person who got 100% in this. If you could read for us. If you could just read this paragraph for us, these two paragraphs. Mm, I'm beaming my screen here. I've shared the question in the group. Mr. Muhango, could you kindly read these two paragraphs for us? We're looking at this question here. So I just need someone to read. Sure. Okay, okay. You're not able to see my screen. No one can see my screen. Okay, could you kindly read for us, sir? It's moved out. Sure. Okay. How about now? I'm still just hold on. Mm-hmm. Are you able to see it? Hey. Sure. Who can see my screen? Who can see my screen? Yes, madam. Then you can read for us. Madam, this course, put yourself aside. With this course, ah, okay. Could, could anybody else read? The reason why I don't want to read, colleagues, is because by the time I'm done reading, then I have to now explain again. As I said, I'll be tired. Okay, tired. Yes, Madam Juliet. Then B, compute the weighted average cost of capital for the project. So, colleagues, welcome back to second year. Okay, I know most of you thought that financial management, goodbye. I'm never seeing it again. Unfortunately, we found it here in investment analysis and portfolio management. So here, colleagues, part A, what they want us to compute is first the cost of equity. The cost of equity is the minimum return required to be given to the providers of equity. I repeat, the cost of equity is the minimum return required to be given to the providers of equity financing, which is the shareholders. Okay, that's the return that will make the shareholders happy. Uh-huh. I'll post it, sir. I'll post it, sir, because it means after. Okay, don't worry. I'll post this. Okay, this is your residential test. You should have it in hard copy. Mm, yes, as I was saying, cost of equity, the minimum return required to be given to the providers of equity financing, which were the shareholders. All right. So here we're going to have to calculate the cost of equity. We're going to need to use the capital asset pricing model. The reason why I'm saying we need to use the capital asset pricing model is because of the information given to us. Okay, we've got an equity beta of 1.28. All right. We've got a risk-free rate of 12%. All right. And we've got an average market return of 18%. Okay. So I'm going to explain what each of these terms mean. What I need you to remember, the cost of equity, what it tells us in simple terms is that the higher the return, the higher the risk, the higher the return. Okay, colleagues? That's what the capital asset pricing model is telling us. Higher risk, higher returns. Okay? So this is the formula for the capital asset pricing model. The risk-free rate, okay, the risk-free rate, this is the return on government securities. Okay? Government, since they are the ones who print money, so it's unlikely that they'll default when it comes to paying you. That's why we call it risk-free rate. Okay. So if you see any treasury bills or government bonds, other times they'll even blatantly say it risk-free rate. Right? Yes. Equity beta, this one here, it measures the risk associated with stocks or shares in relation to the market. Okay. The market has an equity beta of 1. So if any shares or stocks have an equity beta greater than 1, they are of high risk. Since they are of high risk, if you invest in them, you expect higher returns. If the equity beta of the shares or the stocks is less than 1, it means those are less risky. Okay? And less risky shares or stocks expect lower returns. Now, since if you're going to be a portfolio manager, right, someone gives you their money to invest for them, okay, would you invest in risky shares or less risky shares if you are a portfolio manager? Let me start with Madam Chilufia. Would you invest in risky shares? Someone has given you their money and you're compounding, you're making a portfolio. Would you would your portfolio consist of companies that have got high risk attached to them? Their shares have got high equity betas. Madam Juliet, Madam Mary. Huh? I never heard you, Madam. Yes. Madam Mary, Madam Noria, Madam Sophie, Madam Tandil. Yeah. Yes. Okay. Because that's true. No, actually, it's true because a lot of us here were not big risk takers, and if you're managing people's portfolios, you would try as best not to engage in any risky investments. Okay, because the chances of losing money are high, but also the chances of making big money are also high. But the thing is, you do not want to use somebody else's money because if you make a loss, it's going to be hard to explain to them. Okay. Yes. Okay, back to the question here. Then here, the return on the market, okay, which was this 18%. This is the average return, okay, you expect to get if you invest in the stock market. Okay, if we say the return on market for the Lusaka Securities Exchange, LUSE, is 18%. What we just mean is, on average, if you buy shares in a company which is in the Lusaka Securities Exchange, you expect to make an average return of 18%. Okay. Then equity beta, as I told you, measures riskiness of shares in relation to the market. Okay. So once you've got these figures, you just put them in. Okay. Risk-free rate 12%, equity beta 1.28, return on market 18%, uh, risk-free rate again here 12%. Oh, one thing I forgot to also mention. This return on market, of course. Mm. Okay, it's being recorded. Colleagues, if the screen stops showing, what you can do is try to log in and log out so that probably when you come back, the screen shows. But I'm recording this. Okay. Yes, I'm recording this. Sure. Okay. Okay. So, as I was mentioning, this return on market minus risk-free rate, this is what we call our equity premium. Okay. Equity premium is just the additional return that you get when you choose to invest in securities that are not risk-free. I repeat, equity premium is the extra return that you get when you choose to invest in securities that are not risk free. Okay. Yes. So we do our tabulations here. So you do order of operations. You start with the brackets 8 minus 18 minus 12%. That is 6%. 6% multiplied by 1.28. Let's just confirm these figures. 6 times 1.28, 7.68%. All right. Then you add it to this 12%. 12% plus 7.68%, you get 19.68%. That is the required return. All right. Or the cost of equity, KE. Any questions? Any questions, colleagues? Oh, I forgot. Everyone got 100% in this, so we all got 19.68%. Okay, we move to part B, where we have to calculate the weighted average cost of capital. Colleagues, what's the definition of the weighted average cost of capital? No one can say, no, sir, we do not know. You all remember. And I took most of you in financial management, so you must remember. Madam Chirufia, what is the weighted average cost of capital? Yeah, 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 yeah. Mr. Muhango, what is the weighted average cost of? Please do, Madam Noria. Wonderful, wonderful, wonderful. The minimum return required to be given to the providers of capital. Is that okay, colleagues? The minimum return that is required to be given to the providers of capital, the shareholders and the debt holders or the lenders and the preference shareholders if they're also there. Or The other way you can look at it, it is the overall cost of financing for a business. Overall cost of capital. When you just say cost of capital, just think of cost of financing. So it is the overall cost of capital. If you look at it from the business's perspective. And if you look at it from the investor's perspective, it is the minimum required return to be given to the providers of capital. Are we okay with that, Madam Mary, Madam Sophie, Madam Tandiwe, Madam Juliet, Madam Chilufia? Wonderful. You thought that you would leave this in second year. I was telling you, colleagues, it's coming back in fourth year. No, sir, it's not coming. Here it is. All right. So if you remember the formula for the weighted average cost of capital, okay, it's the market value of equity over. Let me put it like this because this way is confusing. Market value of equity over market value of equity plus market value of debt. This is the weightage, okay? Out of you, this weightage, what this weightage is telling you, colleagues, is out of your overall financing, what percentage is equity financing? Okay, these are the weightages here. Okay, multiplied by cost of equity plus the market value of debt over market value of equity plus market value of debt. Okay, out of your overall financing, what percentage is debt financing? That's the weightage for debt, multiplied by the cost of debt. One, the after-tax cost of debt. Okay, colleagues? So in this question, okay, you must thank God that these were already calculated for you. Have you seen there? It uses 40% debt and 60% equity. Those tabulations have been done for you. So just pray this question comes as it is. Okay. Just pray it comes as it is. So they have already done this for us. And we've been given the after tax cost of debt is 18%. Okay. So this corporate tax here, do not subtract it again from this 18%. Because we've already got the after tax cost of debt. Okay, colleagues? Yes. So here in this formula, they said we use 60% equity financing. So you say 60% multiplied by the cost of equity. Convert this into a decimal. Okay. 19.68. If it to a decimal, it has 0.1968 plus 40% times after tax cost of debt is 18%, 0.18. Okay. Yes. So let us multiply 60% times 0.1968. What do we get? 60 times 0.1968. What value are we getting? Colleagues, I hope you never didn't come with calculators. Uh-huh. Okay. 11.86. 7.2. Yes. 7.2 plus 11.86. Okay, 19.07%. Yes. Any questions, colleagues? That's how you get the work weighted average cost of capital. Questions, queries, clarifications. We go to the next part. Outline the concept of the capital asset pricing model, explaining the meaning of beta in relation to. Yes. Yes. No, madam, stay in because I'm going to raise a lot of important points which you need to get down. Yes. So stay in. Okay. Then once the video is posted, what you can do right now is get a paper and pen so that when I'm speaking of the important points, you can remember them. Okay. Okay. So the question was asking us explain the concept of the capital asset pricing model and explain the meaning of beta in relation to investments. So I already explained this. Let me see if people remember. What does the capital asset pricing model tell us again? Mm-hmm. Okay. Okay, just a correction on that one. The market beta is always one. Okay. That's the reference point. So beta is the how risky or volatile a share is, share or stock is. Okay. In relation to the market. So the market's beta is one. So if a stock's beta is greater than one, let me just send the link to somebody, just hold on, call it. Yes, if the stock's beta is greater than one, it means it's more volatile and risk. And if it's less than one, it's less volatile, less risk. Okay, then capital asset pricing model estimates the required return on an investment based on its risk. As I said earlier, higher risk, higher return. Okay. If we look at this previous example here, okay, the beta was 1.2. All right. Let's say, for example, if we increased the beta to 5, okay, you're going to notice that the required return is going to increase. Okay, let's just increase the beta to 5 so that we see what the required return becomes. Okay, higher risk, higher beta, higher volatility, higher return. So just do that tabulation. Someone's asking for the link, so I'm just looking for where to send. I want to send them the link. 18 minus 12, that is 6. 6 times 5, that is 30. 30 plus 12, that's 42%. Okay. So have you seen that the return has increased? Okay. The return has increased. Okay. Then if you reduce the beta, if let's say the beta was 1, okay, then the return goes down to 18%. So as you can see, the higher the beta, the higher the risk of, of volatility of a stock, expect a higher return. The lower the risk, the lower the return. Have we got that, colleagues? That is the capital asset pricing model. Okay. Showing you the relationship between risk and return. Higher risk, higher return. Lower risk, lower return. Do we have any questions, colleagues? Because I saw that capital asset pricing model was also one of the topics which you are told to focus on. So you need to put in that when explaining in the exam. You need to put in spices, yeah? More meat, fattening the cow so that you get maximum marks. So have we got that concept? I'll start. Madam Chilufi, have you got the concept of the capital asset pricing model? Madam Juliet? Hey. Like I will repeat. Madam Mary? Miss the assimilations are here. Where not when you're alone. It's here. That's where we do the assimilations. Okay? Okay, I'll I'll put that sentence in a correct manner, but you've got I can see you've got something from there. So I'll repeat it, don't worry. But thank you for your contribution, madam. Okay. Mr. Mike, I know you have just joined in. Madam Noria. Uh-huh. Yes. Yes. Colleagues, have we got that? The capital asset pricing model. Okay. It shows the relationship between the risk and the required return. Okay. This is on the investor side. Okay. Because on the business side, CAPM is just used for calculating the cost of equity. Okay. So you can also say the higher the risk, the higher the cost of equity. Okay. But let's focus on the investor side. So the capital asset pricing model shows the relationship between the risk attached to a share or a stock for a company and the return. The higher the risk, the higher the return. Okay. The lower the risk, the lower the return. If you include that in your answer, I think you should hit the nail on the head. Okay. Mm, you should hit the nail on the head there. Mm, The way you phrase your sentence, no, not like that. Eh, what we can say is ideally, if you want high returns, go for risky securities. If you want to make a lot of money, you want to get rich, go to buy shares that are risky or volatile, okay, unpredictable, basic, okay. Uh, Then if you are not a risk taker, go for securities that of lower risk or lower volatility. Or you can even go for government securities, which are risk free. Okay. Mhm. And as we saw with that equity premium, which I showed you, I think even as you're explaining the capital asset pricing model, I think it would be advisable to also speak about the equity premium, which is the extra return you're getting for choosing riskier investments over risk-free investments. Okay, this equity premium which I talked about. Mhm. Yeah, equity premium. This the return on the market minus the risk-free rate. Okay. This equity premium, colleagues, it's just the extra return you're getting for choosing riskier securities over risk-free. Okay. Like in this question here, if you choose to invest in the treasury bills, your return is 12%. But if you choose to invest in shares in companies which are in the stock market, you expect a return of 18%. Okay. Yes. Any questions and queries? We have to get this concept understood. Okay. I know you're all graduating, so maybe some of you this will be of no use. But colleagues, actually, it can be of use because if you, especially if you want to invest for your children, okay, invest in these treasury bills, okay, or now treasury bonds, the ones which are long term, okay. The money will be building up. Pa, 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 pa. It might not be a lot, depending on how much. Because the other thing is this: the more money you put in, the more money you expect to get out. That's the other thing that you have to take. The more money you put in, so it's almost like gambling, colleagues. This is similar to gambling. The stock market and these bond markets, there's a similarity with gambling. So if you want to get rich off of this stuff, you have to put in big money and you have to invest in risky investments. Okay. But if you want to make small money, conservative, okay, then you go to less risky investments. And then the more money you put in, you're going to get a noble return. Okay. Yes. So, any questions before we move to the next part, which is asking, explain the implications of systematic and systematic risk. Okay, so systematic risk, okay, which is the risk the equity beta focuses on, is the risk that affects the entire market or the economy. It's not just one company or one industry. Sorry, correction. Equity beta is for unsystematic because it's the riskiness of the share. That share represents a company. But yeah, systematic risk. It affects the entire market or the economy. So you as a portfolio manager, you cannot avoid this risk. Okay, you can't avoid this risk by diversifying, meaning you buy shares in this company, you buy shares in another company. Okay, you buy shares in companies in different industries, trying to minimize this systematic risk. It's unavoidable, colleagues. Okay, examples of systematic risk: recessions, when the economy is doing bad. During recessions, stock prices of companies also tend to plummet. Okay, Interest rate risks when the central bank increases the cost of borrowing. Okay, wars or political crisis, right? Pandemics, inflation. Okay, these risks affect the entire market. Okay, they are not industry specific and they are unavoidable. You just have to pray. This is where you leave it in the hands of God because you've got no control over this. Okay, we just have to pray things go well. Just pray the economy is well. The if your portfolio is dealing with uh, companies in one country, just pray that company, the economy is doing well, right? Share prices are rising, all right? Just pray that interest rates don't rise, making the cost of borrowing high. Because when the cost of borrowing is high, these companies need to borrow that money to expand. Okay? The, if a company expands, it gets bigger profits. That's a benefit to shareholders because bigger profits can relate to bigger dividends. Okay. Then you've got unsystematic risk, which is now industry specific. Okay. And this one, as someone who manages a portfolio, you can avoid it. Okay. You just diversify your portfolio. Okay. So that if one industry is affected, okay, the other industries will be okay. Right. Yes. So examples of unsystematic risk. Let's say there's a company scandal. Okay. There has been fraud. How do you think that will affect your portfolio first? Maybe let me ask this. If there's fraud in a company and you've got a portfolio which has got shares in that company, how do you think your portfolio will be affected? Yes, Mr. Crucial. Because as you write the exam, you have to put yourself as someone who's managing a portfolio. Okay, then you buy shares in, let's say, Zambif. Then there was that scandal, remember, for is it um, the embalmed meat and whatever. How do you think your 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 shares will be affected there? Yes, Madam Chilufia. Mm-hmm. Mm-hmm. And you find now share prices of that company drop. So they're trying to now, if you're trying to sell those shares, you're going to be at a loss. Dividends also can get affected. Okay, because even customers might stop buying. Okay, so the company makes less profits. Less profits, you can expect less dividends. Because remember, colleagues, whenever you buy share in your portfolio, you bought shares in different companies. What you're expecting to get is either dividends or, if you want, you can resell those shares at a higher price to somebody else. Okay, resell them, somebody else, you make your profit. You even exit the market. Okay, maybe you sell some, you still keep some. Okay, those are some of the ways you can make money with that portfolio. Okay, so now if the company there's a scandal, sales are going down, investors are pulling out, share prices are going to drop, and I don't think you can expect dividends that year. Madam Juliet, would you expect dividends? The company has hit a big scandal. Would you expect a dividend that year? No, you wouldn't. Okay. Yeah. Another example of systematic and systematic risk, product failure. You launch a new product, okay, and it's not selling. Okay. It means if it's not selling, less profits for the company. Less profits for the company. You can't expect dividends. Okay. And if investors are seeing that it's failing, they're going to start pulling out. Okay. People now start selling their shares, trying to get their money so that before the share price drops. Okay. Mm, we've got bad management decisions. Okay. What else? Industry specific problems. Let's say, for example, a new law is enacted in that industry, and maybe you find now the cost of doing business becomes expensive, and companies start suffering there. Yes. So, unsystematic risk, as I said, this one you can avoid it since it's industry um, specific. So, you can just diversify your portfolio and you'll be safe from it. Okay. But then systematic risk will always be there. And it's a matter of just hoping things go well in that country's economy. Hope there's no high inflation, there's no recession, okay, there's no war. Yes. And my colleagues, we can pause here for tonight.